So first thing first, there are three major ratios that you should remember. The ratios are called current ratio, quick ratio, and cash ratio. The calculations are very simple. The current ratio says it is current assets divided by the current liabilities. Then you have something called the quick ratio. There are two ways to calculate quick ratio, but as per our books, we should ideally be calculating this as cash plus bank plus very, very liquid assets, which include marketable securities. You have cash, bank, liquid assets, marketable securities, plus debtors for you, and then you divide it by the current liabilities. So the denominator kind of remains the same. And the third one, and a very simple one, is called cash ratio. This is just as simple as current ratio. Cash ratio is basically cash. Of course, cash plus bank plus very, very liquid assets like marketable securities divided by current liabilities. So this basically tells you that just the discussion that we were having. Earlier, I was trying to calculate 75 minus 25, which is equal to 50. Now what I'm saying is 75 divided by 25, which is saying 3x, which is to say that absolute numbers don't really make a lot of sense. Having a 50 worth of working capital doesn't give me enough indication. But when I say, you know what, my assets are 3 times my liabilities, that gives you comfort, right? Okay, for every 1 rupee of amount that I owe to the current liquidity providers, I have 3 in the total assets, which means there's a lot of playing ground for me. There's a lot of margin for error, which I've incorporated within the business. Quick ratio, there are 2 ways to get to it. The second way, which is what you're not supposed to do, but 99% of the cases you'll get the same result, is to say that quick ratio is nothing but current assets minus inventory divided by current liabilities. This is the other way to get to the same equation, because if you look at my numbers over here as well, the calculation was that you add cash, you add bank, you add liquid assets, marketable and all of these things, but you add debtors as well. What you don't add is inventory. So other than inventory, basically I add everything up and I divide it by the current liabilities, and I say that this is my quick ratio. Why? There are 2 things that you have to understand. The reason why you call it quick ratio is because you're trying to figure out what are the assets which are quickly convertible into cash. So in current assets, theoretically all current assets are supposed to be convertible into cash very quickly. You can convert bank into cash very quickly. You can convert marketable securities into cash very quickly. Actually, bank into cash is a wrong statement. Bank and cash should be seen as the same asset, but you can convert any marketable security into cash very quickly. You can sell any security and get money very quickly. You can also go to your debtors and say, you know what, you owe me money, come on, give it back to me very quickly because I have to repay my creditors. So those are the ones which you can convert very quickly. So those are basically to say that these are assets which are under your control. Cash is cash, bank is bank. Very, very liquid assets are also under your control. You have like a hold on them. If you want to convert it today, you can convert it today or maybe by Monday. Same goes for debtors as well. You can just call him up and say, boss, you have to pay me back because I'm supposed to pay it forward as well. So they are also somewhat under your control. What is not under your control is inventory. Because an inventory, let's just say you buy and sell mobile phones, right? You may be sitting on 50 mobile phones at a given point of time. Let's just say there are 50 iPhones, all worth £1,000. You can't say that, you know what, this is very marketable, I'll convert all 1,000 phones into cash tomorrow. It depends upon how quickly you're able to sell it. So that is an external factor of sales which comes into picture when you're talking about converting inventory into cash. But there is no external factor in converting cash, bank or liquid assets or debtors into cash. They can be converted as per your needs and requirements, right? So because of that reason, we calculate quick ratio, which is to say, I'll not think about inventory because inventory is an external factor. I'm not sure when I'm going to be able to sell. If I shut my office for a month, I will be able to convert 0 inventory into cash. But even if my doors are shut, my cash is cash, my bank is also cash, my liquid assets can be converted because I don't have to open my door. I can just, I don't have to open my shop. I can just sell the liquid assets into the market and get my money back. And same goes for debtors as well. I don't have to open the store. I can just call him up and meet him outside my office and get my money back. So I don't need necessarily, I'm not dependent upon an external factor in converting these kind of assets into cash. So for that reason, you have a quick ratio. Finally, when you're trying to be even more conservative, you go to cash ratio. You say that, you know what, I said that inventory is 100% dependent upon external factors. Debtors to an extent are 50% dependent upon external factors. Like half the time I call my debtors, they'll give me money. Half the times they'll say, you know what, I also don't have money. I'll need another week or so. So when you want to even eliminate that factor of having any externality within the picture, you get to cash ratio, which is to say you only take into account the cash, the bank balance, and how much money you have in very, very liquid assets, or in our syllabus, we'll call them marketable securities. And you divide it by the current liabilities. And you say, you know what, these are absolutely under my control. These are bank balances readily available with me, and I can utilize this to make payment tomorrow if I want to. You can't utilize debtors to make tomorrow if you want to. And of course, you can't utilize inventory to make any payment tomorrow if you wanted to. So these are three ratios which help tell you how much amount over and above the current liability are you holding at any given point of time. The more you have, the better the margin you are going to have, right? So that is why these three ratios become important in the overall context, and they tell you as to, you know, what are the things or what are the factors that you can build within your, overall payment cycle in order to, and what payment cycle and everything else is, we'll get to that. But it will give you a little bit of comfort in being able to say that I have liabilities of 30 and I have assets of 30. So you'll have a peaceful